All right, let's dive right into Alaska Air Group's latest earnings report. And this one is a really interesting puzzle for investors. You've got this story of strong performance right now, clashing with a super cautious look ahead. So let's unpack what's really going on with ALK.
So the first thing that just jumps off the page is this number, 43 cents. That was their adjusted earnings per share. Now in the airline world, a number like that for the fourth quarter is pretty solid. But what makes it a real headline grabber is how it stacks up against what everyone was expecting.
And this slide right here really puts it into perspective. It was a massive beat. The street, the analyst consensus, was only looking for 12 cents. Alaska came in and delivered more than 3 times that. That's the kind of outperformance that sets the whole tone for the story. So the question is, how'd they do it?
That huge earnings number is the headline for sure, but the real story is always in the details, right? So let's pop the hood and look at the core financials.
Okay, so revenue came in at about $3.6 billion. That was actually a tiny miss, but hey, it's still up almost 3% from last year. But here's the number you really want to pay attention to, that premium revenue line. It's up a really strong 7%. That tells you their strategy is working, they're getting more people into those higher margin seats. And that's what helped them get to that solid 1.8% adjusted pre-tax margin.
So how did the market react to all this? Well, it was a wild ride. The stock was actually down in after-hours trading right after the report dropped. But then, as investors and analysts really dug into the conference call, the whole narrative flipped. The stock rallied and ended up closing over 4% higher. That volatility, that really gets to the core of the whole debate around this stock right now.
And that brings us right here to the central conflict of this whole quarter. You've got this clear story of great execution today, paired with this very hedged, almost nervous outlook for tomorrow.
I mean, on the execution side, you can't argue with these numbers. We already talked about that 7% growth in premium seats. But look at this. Cargo revenue up a massive 22%. Loyalty revenue up 12%, and corporate travelers coming back strong up 9%. And maybe most importantly, they got their single operating certificate with Hawaiian. That is a huge step in making that merger work and takes a lot of risk off the table.
But then, management completely changed its tune. Despite all this fantastic momentum, the guidance they gave for the future told a totally different, much more cautious story.
For the first quarter of 2026, they guided to a wider loss than anybody was expecting. And for the full year, well, that range of $3.50 to $6.50 per share, the middle of that range is actually below what the street was hoping for. So the big question is, why?
Why is there such a disconnect? I mean, how can you have this conservative guidance at the same time management is talking about these incredibly strong demand signals on their earnings call? This is the exact puzzle investors were trying to piece together.
And this slide just lays it out perfectly. On one side, you have management talking about big picture worries, the macroeconomy, volatile fuel prices. But on the other side, they're telling us corporate bookings are up 20% year over year, that advanced bookings look robust, and get this, they had some of the highest booking days in the company's entire history just this past January.
And if that wasn't enough to make you scratch your head, the CEO himself came out and said momentum is accelerating into 2026. I mean, that language sounds way more bullish than the official numbers they put out, doesn't it? And look, this positive momentum isn't just talk. It's backed up by real operational wins. Getting that single operating certificate is proof they can execute. This is a huge milestone. It basically means the FAA now sees Alaska and Hawaiian as one single airline, and that's the key to unlocking all the cost savings and efficiencies from the merger. It's a tangible achievement that really adds weight to the bull case.
So you put it all together, all these conflicting pieces, and what's our call on the stock from here?
We're watching 3 big things. First, can this amazing demand keep up? Second, can they continue to execute on integrating Hawaiian smoothly? And third, will the outside world cooperate? Will fuel prices calm down? And will the broader economy hang in there?
So our analysis leads us to an outperform rating. We just believe the strong demand we're seeing right now, their proven ability to get things done, and the benefits from the merger, we think those are more powerful than the fears that are baked into their conservative guidance. It really feels like management is setting a low bar that they are in a great position to clear.
Okay, so based on that outperform rating, we've got a little trade idea for how someone might think about playing this dynamic.
We're calling it the guidance hedge, and the thesis is pretty simple. You make a structured bet that the stock is going to do better than management's cautious numbers suggest, but you do it without taking on crazy amounts of risk. Essentially, the strategy involves buying an option that pays off if the stock goes up, while at the same time selling another option to help pay for it. It's a capital-efficient, risk-defined way to bet that the strong demand story is the one that's going to win out.
So we'll leave you with this question. When you have execution this strong, but an outlook this hedged, is Alaska Air just setting a very low bar that it's perfectly poised to leap right over in 2026?
And as always, please remember, this is not financial advice.